Really excited today to walk you through how we're leaning into this opportunity to really be driving efficient growth. And the starting point of this journey is our operational and financial execution. In a very choppy environment over the last year and a half, we've been building a track record of delivering on our commitments, even in the face of these choppy waters that are out there. And we've been able to drive very durable growth. The product market fit that we have, coupled with our go-to-market execution, and this move from batch processing to streaming has really been driving high rates of NRR, compounding and durable growth. And we've been delivering all this growth while really managing and balancing profitability. We've been very much focused on working within a framework. We had a target model that we outlined at the time of our IPO. That's guided our journey on this. And we've been able to deliver very high rates of growth, greater than 30%, while delivering lots of operating margin improvement. In fact, in the last 3 quarters, we've driven over 10 points of annual operating margin improvement for each of the last 3 quarters. So I want to take a few minutes to look behind the details of these. And this starts with the strong execution. The momentum since our IPO, we went public about 2 years ago. Our total revenue run rate has now reached approximately $700 million, and that's doubled. Our cloud revenue run rate is approximately $300 million, and that's grown more than 5x. And we've delivered 18 points of operating margin improvement during this time period. And it's also driven by best-in-class NRR and gross retention metrics. When you look at our progress on both the top line and our path to profitability, we've achieved roughly $700 million in revenue, and we expect to be profitable in Q4 of this year. And the company's 9 years old, and that puts us in the top quartile of performance relative to peer group. So on multiple dimensions, is differentiated from the alternative offerings. The TCO and ROI characteristics that you've heard about earlier today are compelling to our customers. We're able to serve our customers' needs wherever they are, on-prem, in the cloud, in multi-cloud environments. This creates a big competitive moat for us relative to most solutions that are out there. And this differentiation has driven a 70% CAGR. And in the early years, most people know that the growth was primarily driven by Confluent Platform, our on-prem offering. But over the last several years, the growth has really been driven by our Confluent Cloud offering, and that became a catalyst for future growth. Cloud now accounts for 42% of revenues, and we expect cloud to account for about 48 to 50% of revenues in Q4 of this year. All of these characteristics have led to strong customer commitments. RPO at the end of 22 was $741 million, and that grew at a 70% CAGR. And all of this RPO performance has really helped us with visibility and predictability. One of the key measures that we track is CRPO, and CRPO coverage to revenue is tracking at or above 60%, and the CRPO CAGR over this time period is 69%. And again, these dynamics have created visibility and predictability, and it's really helped us deliver on our quarters ever since we've been a public company. Now, while our hybrid model of selling both Confluent Platform and Confluent Cloud is important, I'll tell you, cloud is leading the way. It's powering the top line. Customers are developing new applications with a cloud-based premise first, and they're moving existing workloads to the cloud. Now, we are a cloud-first company today, and we are 10x better than a do-it-yourself Kafka approach, and our cloud product now has best-in-class NRR. More than half of our customers that have over $100,000 in ARR are using Confluent Cloud, either on a standalone basis or in conjunction with Confluent Platform. Another driver of this growth and strong, consistent execution has been our diversified customer base. We have 4,690 customers. The customer count has grown 10x since 2018, and we're in over 100 countries around the world. And we serve nearly every industry that's out there. So it's a highly diversified customer base and industry base. Now, let's turn to the durability of our growth and the 3 core drivers that underpin it. First, it starts with TAM. There's a large and growing $60 billion total addressable market today. Our differentiated customer growth go-to-market model, which is purpose-built for data in motion with best-in-class NRR, has led to this compounding durable growth. And our cloud consumption model is powering growth as our customers are running mission-critical workloads across all of their environments, whether it's on-prem, in the cloud, or multi-cloud. So I want to take a moment to double click into each. The $60 billion TAM, it's a new category that we've created. Earlier today, Sean and Jay went through the TAM construction. I would really like to focus on a couple things. The first is with the addition of Flink, this enables us to capture our TAM even faster than we had the opportunity before. So that's an accelerant to us. Now, the explosion in data volumes that we've seen and the explosion in applications that's happening across the entire enterprise landscape and what will be coming with generative AI are catalysts for future TAM expansion. And over the next 3 years, we anticipate our TAM to be increasing at a 19% CAGR to about $100 billion. The net of it is this is a big market, and there's a lot of opportunity for growth in front of us. Now, the TAM is also supported by the significant opportunity that we have for converting open source do-it-yourself Kafka customers to Confluent Cloud. There are over 150,000 do-it-yourself Kafka users that are out there today, and we have 4,690 customers. Our Confluent Cloud offering is far less expensive than the alternative offering. If you think about what we deliver, there is less personnel that's needed to run our Confluent Cloud offering than a do-it-yourself Kafka implementation. There's less bolt-on software, there's less infrastructure costs, and the overall TCO and ROI is very compelling. In a nutshell, it's faster, better, and cheaper. And the technology has broad adoption across all of the industries that we play in. You saw these stats earlier today. Over 75% of the Fortune 500 run Kafka, and we have about 36% of those customers today. So there's a big opportunity for us to grow in this segment. Now, our product market fit and go-to-market model is a powerful combination that's led to strong growth in large. And we have 1,075 customers that have spent over 100K in ARR, and they account for more than 85% of revenue. And that's been consistent ever since we've been public. This cohort has grown 6x since 2018. Now, moving up the stack, we have $135 million plus customers. That has grown 12x since 2018. And we have a growing number of $5 million and $10 million ARR customers. So when we evaluate our customer base and we look at the opportunity to grow and expand, in many of these customers, we're still in the early innings of our ability to satisfy their needs for real-time data in motion. So we have a lot of to capture more wallet share. The second core driver of our differentiated customer growth go-to-market model, which powers our land, expand, and consumption engine, is these NRR and gross retention metrics. For 8 quarters in a row, we've delivered net retention rates above 130% and gross retention rates above 90%. In particular, our cloud business is a standout performer. We're above 140%. And the highest NRR that we see is for the newer cohorts. And then you've heard this earlier today. We have very strong network effects within the organizations that we serve. This network effect has really translated into, as more applications and data stores get connected into our platform, it begets more applications and data stores need to be connected. And so we've seen that manifest itself in a 3.5 plus X ARR expansion after 4 years. Now, we have a powerful cloud consumption model. Erica presented this cloud consumption model a little bit earlier, but I wanted to share a few additional points. The reason why it's unique and powerful is because it's a revenue-generating model due to the network effects I just described. And we're running mission-critical workloads. And as a result, these workloads often come pre-optimized. And over the last 12 months, in a tougher business environment, our consumption model has actually held up very well. We've been showing compounding growth in our consumption model. And it's due to the characteristics I just talked about. And our consumption model, I would just say, has held up better than maybe some other consumption models that are out there. And that's due to the nature of workloads and where we sit in the technology stack and the mission criticality of the workloads that we're running. All of this has led to compounding growth. Our top 20 customers for cloud span 11 unique industries. Approximately half of them started on pay-as-you-go, and about 40% of them are hybrid customers. In this cohort of customers, it's taken 6 quarters for them to get to $1 million of ARR. Very, very quick. And the average ARR across this cohort base is $3 million, and that's up from 0.6 million just a couple years ago. And the total ARR multiple is 17x. Again, this demonstrates the power of our customer growth go-to-market model and the land, expand, and consumption characteristics that we have. Now, increasingly, as the enterprise continues to move workloads to the cloud, our install base of Confluent Platform customers are adopting Confluent Cloud. This perhaps is maybe one of the areas that isn't as well understood by some folks who are looking at Confluent from an investor standpoint. So looking at the cohort of these hybrid customers who run both Confluent Platform and Confluent Cloud and spend over $100,000 in ARR, the customer count has grown 70x. And there are a few attributes to highlight in this cohort. The majority of these hybrid customers started with Confluent Platform. There's an inherent cross-sell and upsell opportunity that spans both Confluent Platform and Confluent Cloud customers. And this cohort in particular has a high ASP and a higher cloud expansion rate than the average customer that's out there. Doing another double click on our cloud business and to put a finer point on things around the power of our consumption model, here are two examples of marquee customers that started their journey with us and what the profile of their expansion is. So the first is a large international bank that started with about 100K in ARR and grew to 34x to 4.6 million. The next is a multinational manufacturer that started on cloud as pay-as-you-go with 50K and expanded over 192x to 4.3 million. So the progress that we're making in these customers puts us on a path to be the central nervous system as they deploy Confluent more broadly across their environments. Now I'd like to take a few minutes to look at how we have managed growth and profitability. We've been committed to driving efficient growth, and we shared a framework and a target model at the time of our IPO that we're going to be updating today. But first, I'm going to start with our path to date. Starting with the top line, even in this difficult macro environment in FY22 and FY23, we've been able to navigate the environment pretty well, and our growth has been resilient. We continue to expect that we're going to hit 760 to 765 million in this fiscal year. And while there are about 3 weeks left to go in the quarter, and like every quarter, we're going to have work to do in these last 3 weeks to land the quarter, the consumption patterns that we called out on our earnings call are holding up in line with our expectations, and we're currently tracking to our Q2 guide. And so the growth drivers, we previously covered these section, so I'm not going to cover each of them, but I do want to just reemphasize that there are multiple growth drivers to this business that we can cover during our cocktail hour as well. Turning to the unit economics of the business, we've made great progress on gross margin, and this has been a really high point for the company. And we've done this despite the revenue mix shifting to cloud over the last 3 years. Now, we're actually updating our gross margin target for FY23. Originally, it was 70 to 72%, and we now expect gross margin to be in the range of 72 to 73% for the year. Now, the drivers behind this, we've continued to have very healthy gross margins for Confluent Platform, but the work we've done around our Confluent Cloud offering has been very robust. We've achieved scale in the cloud hosting costs. The new product and feature releases that we've been coming out with have increased the value that we're delivering to customers. There's been a lot of work and effort going into engineering and infrastructure engineering to get more optimizations. And we're also seeing an increasing mix of multi-tenancy for cloud, and that it comes at a much higher gross margin. Now, we also understand this work is never done. And this is something that we're laser focused on, and we're going to continue to work to drive efficiencies. Now, turning to OpEx and operating margin, we've been disciplined in terms of where we're making investments. We've been controlling the rate and pace of hiring to ensure we're driving leverage and while also delivering high revenue growth. The investments in product and sales capacity have been key drivers, and the pay-as-you-go onboarding of customers has been a key way to drive low-cost onboarding of customers. We've also seen great network effects that have driven expansion, like I talked about earlier, and we've been focusing on improving sales productivity. So these factors have contributed to a very healthy pace of operating margin improvement as we continue to target achieving break-even in Q4 of 23. Now, looking at our path to date and how we've managed growth and profitability, our investment decisions that were powered by this historical model that we had at the time of the IPO were also influencing how we allocated capital. And it's been guided by this growth and profitability framework. The key attributes to call out in the old model, it was predicated on growth rate being greater than 30% and a growing cloud mix of revenue and a high net retention rate and gross retention rate. We're always focused on improving the unit economics and proactively managing expenses. And we actually accelerated our path to profitability by a full year, given everything that had been going on both in the market and then how we looked at the power of our own financial model. So we pulled profitability forward. Now I want to take a minute to talk about the future and what the path forward looks like. As we look at managing growth and profitability over the midterm, we're looking to resource the company for a approximately 30% annual revenue growth rate. We're continuing to proactively manage expenses and the rate and pace of hiring. We continue to expect to achieve operating margin break even in Q4 23. And once we become profitable, in FY24, we intend to remain profitable for, on a full year basis with about 0 to 1% operating margin for the full year. That's going to be another year where we're going to be delivering outsized operating margin expansion of 13 to 14 points on a year-over-year basis. And over the midterm, we're looking at expanding operating margin to roughly 5 to 10% while delivering top-line growth. Some of the key assumptions that underpin this, that macro does not deteriorate materially, and that Flink and FedRAMP continue to perform according to plan. Now, the shape of our business is changing over time, and it's changing to that we're basically becoming predominantly more cloud. We expect approximately 80% cloud revenue mix long term. And with this change comes some benefits of the compounding growth that we've talked about with a high NRR and gross retention rate. Factoring these dynamics into the financial model, we're updating the growth and profitability framework that we had at the time of IPO. So in this new model, we're increasing our midterm and long-term target ranges for gross margin. We're modestly improving the long-term target margin for sales and marketing as a percentage of revenue. And we're increasing both the midterm and long-term operating margin targets and now expect to deliver over 25% operating margin in the long term. It's important to note that the top-line growth will continue to be a determining factor around rate and pace of operating margin expansion over time, because we are continually calibrating the opportunity that's in front of us and the amount of operating margin that we're going to be delivering. And we want to make sure we're taking as much wallet share as possible while continuing to build a profitable business. And there's one more item I'd like to cover, and this is how we're managing dilution. So starting with stock-based compensation expense, most of you know it, it's a lagging indicator due to the ratable recognition of expense. And a lot of this that we've been carrying for the last year or so has been impacted by the pre-IPO options and the significant amount of hiring that we did over the last couple of years. In the second half of 2020, the pre-IPO option expense will end, and then we should start to see some meaningful improvement for SBC as a percentage of revenue. And over the midterm, we're targeting SBC to be approximately 25%, and then we're going to be driving that down to the mid-teens. Now, what we're doing to control future SBC is focusing on managing dilution today. And we're committed to driving net dilution down in FY23, targeting 3 to 4%. And then in the midterm, we're targeting 3%. And in the long term, we're driving that down to less than 2%. So that wraps up my presentation. Now I'd like to introduce Rohan Sivaram, SVP of Finance, to cover financial-related modeling topics. Rohan.
Thank you, Stefan. Good afternoon, everyone. I'm Rohan Sivaram, Senior Vice President of Finance here at Confluent. The purpose of today's modeling session, in my mind, is to help you get a better understanding of our business model and some of our key financial metrics. And as I was thinking through the materials for this session, we've incorporated a lot of the feedback that you've shared with us. So thank you for that. With that, let's just jump right in and talk about the power of our hybrid business model. This is more of a setup before I jump in. So as you've heard from most of the presenters today, Confluent needs to be wherever our data and applications reside. Be it in the cloud, we need to be there with Confluent Cloud, or be it on-prem, we need to be there with Confluent Platform. Starting with Confluent Cloud, in the last reported quarter, Confluent Cloud was 50% of the business. And as you know, it is our fully managed cloud-native offering that we have. Confluent Platform was 50% of our business in our last reported quarter, and that's our self-managed software offering. What is not here in the slide is our hybrid set of customers. We have a growing cohort of hybrid set of customers that Stefan touched on earlier. And if you look at the 100K plus cohort, we have over 200 hybrid set of customers. Services is another offering that we sell along with our product sales. And it is primarily sold to accelerate our consumption and obviously help our customers adopt our product better. what I'm going to do probably over the next 10 odd minutes is to walk you through a couple of customer journeys, one for Confluent Platform and one for Confluent Cloud. And as I'm doing it, I'm going to talk about three things. First, we'll do a little bit of a setup, talk about some definitions. Second, I'll walk you through an illustrative example. And last but not least, hopefully we'll leave you with some key takeaways for each of these. So let's get started with Confluent Cloud. Companies and prospects can start their journey with cloud by signing up for free on our website with a few $100s in credits. Subsequently, they can put in their credit cards and become what we call is a pay-as-you-go customer. And pay-as-you-go customers have no contractual commitments. Alternatively, the pay-as-you-go customers or net new customers can commit to a contract with us, whereby they're committing to a level of consumption over a period of time. And these commitments typically happen in either annual or multi-year form, and they show up on our financials as RPO or remaining performance obligations, or CRPO, which is current remaining performance obligations. One thing is when a customer consumes more than they commit, we recognize that incremental revenue as overage revenue. And when a customer is under-consuming, the delta is recognized as expiration revenue. Finally, time to ramp is basically the time our customers take to ramp up to their committed contractual run rate. With that, let's jump into an example and talk about Data in Motion. Data in Motion Incorporated is a company that's currently using open source Kafka. And one of the teams within the company wants to experiment with a managed service, and they decide to choose Confluent Cloud. So they come to our website, quickly sign up, and through our in-product tutorials, best practices, and some of the common recipes that we have available, they quickly become a pay-as-you-go customer. What's interesting about this product-led motion is that it drives organic adoption, it is frictionless, and more importantly, it comes with very low sales touch. Let's look at some of the financials. So in month one, Data in Motion Incorporated spent $1,000 with us, and we recognize that $1,000 of consumption as revenue. From an RPO or CRPO perspective, there is no RPO or CRPO at this point because the customer has not committed to anything. And finally, when you think about the total customer count, Data in Motion Incorporated is now contributing to our total customer count. Moving on, the product, the Data in Motion is starting to use our product, and they're finding value in it. From an experimental use case, they slowly start moving into production. And Confluent offers a lot of benefits, so they decide to sign a $120,000 committed one-year contract with us to take advantage of the volume discounts we offer and to take advantage of the benefits that Confluent provides with respect to support and our expertise. At this point, at the inception of the contract, we see an RPO and CRPO balance of $120,000. And in the first month of the committed contract, in this particular example, they consume $3,000, which is quickly recognized as consumption revenue for us. And as we exit the first month, we are left with $117,000 of RPO. You'll see there is an inverse relationship between revenue and RPO as we move forward. Now we are a few months into the committed contract, and the consumption keeps happening, and we reach the 6-month time period. At this point, the company is spending approximately $10,000 with us, and they've actually hit our net consumption run rate that they've committed to us, which is $10,000. And what's also interesting to note that at this point, they've also crossed the 100K threshold. So when we report our 100K plus ARR customers, this is when they're part of our reporting. One interesting, I'd say, observation here is our time to ramp of 6 months is very unique in infrastructure and is actually a key differentiator of our consumption business model. With respect to RevRec and RPO, we continue to recognize revenue based on consumption, and the RPO balance continues to get depleted. It's also important to note that Data in Motion does not stop growing at this point, which takes us to month 12 of the contract. And as you can see from the chart, they're consuming at $15,000 in month 12 of the contract, which is a run rate of $180,000, higher than what they had initially committed for $120,000. So a couple of observations here. Like from a setup perspective, two things which is really working well for Confluent. First, we're very well set up for net retention and gross expansion at this point, given the run rate of $180,000. And second, I also feel that we're very well set up for future margin expansion because typically a year 2 of a customer is much better from a unit economics perspective than year 1. So at this point, we're in month 15. We don't have any RPO and CRPO, but the customer is consuming and they're getting value out of our product. So they decide to sign a renewal with us. And as they sign a renewal, the size of the renewal deal will typically be at or above the $180,000. Although it's an illustrative example, this shows a typical journey of a customer or cloud customer that we have. Now, bringing it all together, as most of the speakers said, be it from pay-go to commit to renewal expansion, there are a few things that connect all of these. First, it's a deeply differentiated cloud-native model, which helps our customers get started, expand, and scale. Second, our customer growth go-to-market model partners with the customer at every stage of their journey and with the right product, expertise, and go-to-market strategy. And last but not least, our customer success team partners very closely to drive best-in-class time to ramp. With this as a backdrop, let's talk about a few key takeaways for Confluent Cloud. First, as Erica touched on it, pay-as-you-go is a very important piece of what we do, and 50% of our cloud customers start on pay-as-you-go. Our time to ramp is approximately 6 months, which is best in class for infrastructure software. We've spoken about this concept in our earnings calls over the last few quarters. Cloud, as a percentage of new ACV, has been above 50% for 5 consecutive quarters. As a result, our cloud, as a percentage of total RPO, is approximately 50% in our last reported quarter. From a revenue mix perspective, we continue to expect to exit Q4 of 2023 with a mix of 48 to 50% for cloud. And from a revenue seasonality perspective, we expect the lowest sequential add to be in Q1s and more pronounced increase in second half of the year. And finally, when you look at the cloud NRR, that's of course going to be the highest NRR for the company and greater than 140%. Let me switch gears and talk a little bit about Confluent Platform. Confluent Platform is sold as a term-based subscription that's typically billed annually in advance. The Confluent Platform typically has an upfront revenue recognition that happens for the license piece, which is 20% of total contract value. The remaining part of the contract, which is the other 80%, is recognized ratably over the period of the contract. And finally, for RPO and CRPO, Confluent Platform RPO, CRPO is very similar to Confluent Cloud, where we recognize based on our customers' commitments. Let's take the example of data in motion again. This time, they're in an industry where the data resides heavily on-prem, and they come to Confluent and sign a 2-year commitment for $200,000. So what happens at inception? At the inception of the contract, we recognize $40,000 as license revenue. That's 20% of $200,000. For the remaining, we typically recognize that over the period of the contract, which in this case is 8 quarters, $160,000. That's about $20,000 per quarter we'll be recognizing. Let's fast forward to end of year 1. We continue to recognize the maintenance revenue or PCS revenue as we call, and we exit year 1 with an RPO and CRPO balance of $80,000. As you'll see here, the RevRec lines here are very interesting because on Confluent, it's like a curve where it depends on consumption, where this is a lot more predictable and it's every quarter you get the same amount. As you exit year 2, you're basically depleted all your RPO and CRPO, and you've recognized the maintenance revenue over the period of the contract. And at this particular time, the customer is basically in a position where they're going to sign a renewal with us with some amount of expansion, and NRR is going to drive that. Finally, I think a few takeaways for Confluent Platform from a modeling perspective. Like I said, 20% of Confluent Platform revenue is recognized upfront, and the remaining 80% is recognized ratably over the period of the contract. Confluent Platform drives more revenue seasonality than Confluent Cloud due to the upfront revenue recognition. Confluent Platform leads to less RPO than an equivalent Confluent Cloud deal. That's again due to the upfront revenue recognition. And finally, for some of the key metrics like 100K plus ARR customers, $1 million plus ARR customers, or NRR for Confluent Platform is based on consumption. Is based on commit, I beg your pardon, and not consumption. Let me take us home with some key company-wide modeling points. These slides will be posted on our IR website shortly, so I don't plan to go through all of them in detail, but I'll cover a few of the seasonality-related metrics. Let's start with revenue seasonality. When you think about revenue seasonality, we typically expect second half to be more weighted than our first half, with Q1 being the seasonally weakest quarter and Q4 being the seasonally strongest quarter. When you look at non-GAAP operating margins, we expect Q1 to be the lowest, and that's driven by the lower revenue seasonality you see in Q1s and large one-time expenses that we see like company kickoff and sales kickoff that typically happens in the first quarter. And talking about seasonality, when you look at free cash flow, we expect Q1 to have the lowest seasonality or lowest free cash flow, and that's driven by our company bonus payout as well as our ESPP settlement. Hope this helps you get a better understanding of our hybrid business model, and you'll have this information handy on our IR website. With that, I'd like to thank all of you and invite the management team over for some